Directors of limited companies must make informed decisions about their remuneration strategies. Optimizing income for directors involves balancing salaries and dividends while considering significant changes to tax legislation. The importance of optimizing income for directors is more pronounced than ever. With evolving tax regulations and newly introduced rules, now is an opportune moment to scrutinize your remuneration strategy. Should you take a salary, dividends, or a combination of both? The 2025-26 tax year has ushered in changes that demand your attention. One of the most notable updates is the new requirement for directors to report dividend income on the employment pages SA 102 of the self-assessment tax return. This increased transparency means more disclosure about your shareholdings, giving HMRC a clearer picture of your financial landscape. The additional burden of reporting might harmonize with a likelihood of scrutiny regarding your employed status, specifically whether you are classified accurately as self-employed. Understanding your employment status and its implications on taxation cannot be overstressed. Modifications to employers' national insurance contributions have introduced both challenges and opportunities. The threshold for employers' NI has decreased from £9,100 to £5,000 with a revamped rate of 15%. Simultaneously, the employment allowance has increased to £10,500, but the eligibility for the sole director remains confined. Consequently, if you're a single director without employees, this advantage will inevitably slip through your fingers. However, for those with multiple directors in place, it's essential to strategize around claiming this allowance optimally. Examining your numbers, salary versus dividends. To fully appreciate the nuances of optimizing income for directors, let's delve into a practical example. Imagine a limited company recording a profit of £150,000 before any owner's salary considerations. For ease of analysis, let's assume you're the sole director and your salary will primarily influence this financial narrative. When examining the roots of salary and dividends, it becomes evident that each offers distinct benefits and drawbacks. If you opt for a salary, you can expect roughly £68,558 in take-home pay after personal tax, leaving a retained profit of £28,958 within the business. Conversely, if dividends are your preference, you may relish a more substantial take-home pay of approximately £79,961, albeit with a slightly higher overall tax payment of £53,542. This stark difference in cash flow can be attributed to the absence of national insurance contributions on dividends and their lower resultant taxation rate compared to salaries. It's crucial to remember that dividends can only be issued if your company holds sufficient profits, creating an obligation to maintain a robust financial foundation. A hybrid approach often yields the best results. By establishing a strategy that marries both salary and dividends, you can take advantage of predictable income while still enjoying the tax benefits associated with dividends. Regular monthly salaries support steady cash flow and help with personal financial planning, while dividends allow you to capitalize on retained profits. When setting this balance, consider how to align your salary with the new NI thresholds, ensuring you do not miss out on potential allowances while also forecasting your profits for the year ahead. Developing a clear dividend strategy that reflects both your income needs and the necessity to reinvest into the company is essential. Planning for the future. 4 key tips. Forecast your profits. As you look forward to the year ahead, create realistic projections of your company's earnings. Understanding potential profits will be critical in determining how much you can afford to draw in salary or dividends. Calculate your salary level. Given the revised £5,000 NI threshold, establish your salary strategically. Keeping it above this threshold may reduce tax liabilities, and accurately forecasting monthly payments can support financial planning. Set a dividend strategy. The timing and amount of dividend payments should align with your expected profits. This prevents the pitfall of issuing dividends when profits are insufficient, avoiding directors' loan issues. Quarterly reviews. The financial landscape can quickly change, making it critical to reassess your remuneration strategy regularly. By reviewing your approach quarterly as your financial position and profits become clearer, you can stay agile and responsive in your planning. Optimizing income for directors is not a mere mathematical exercise. It requires aligning personal goals, tax considerations, and business health. Both salaries and dividends have their unique advantages, which, when harnessed correctly, can create a robust financial strategy that supports you and your company. Seeking professional guidance from a tax advisor, such as myself, tailored to your situation, is advisable, ensuring you navigate complex regulations and make the best financial choices moving forward. Your financial future deserves careful consideration and strategic planning, so don't underestimate the impact of these decisions. If anything I've written in my blog post resonates with you and you'd like to discover more of my thoughts about optimizing income for directors through salaries and dividends, then do feel free to call me on 01908 774 323 and let's see how I can help you.